Today, we're going to look at how you know if your property report is accurate. Following on from that, we're going to see with fixed rates increasing, how that might affect your borrowing ability.
And in the last week, one of Australia's biggest buildings gone broke. We're going to go through what happened with that collapse and how it might affect you if you're thinking about building this year.
And we're going to finish off with a bonus of Domain's most viewed properties across Australia. Let's dive right in. So let's start off with finding out how you know if your property report is accurate.
You might be using a number of services on the web, or your broker might be helping you with the CoreLogic RP data report, which is probably one of the most common. A thing we are seeing all the time though, Nathan, is that you might be trying to find a house, you're gonna make an offer, you check out online, you try and work out what you're gonna make, but you're not sure where to start. As an example, we're gonna use a home that recently sold in Brisbane, in Moggill. As you can see here on Domain, they're saying between $550,000 to $730,000. Real Estate View is giving an estimate of $600,000 to $650,000. And even NAB Insights are saying $553,000 to $649,000. So the hard thing to know when you're seeing a property these days is where do you start your offer and what can you trust?
So let's dive into how you can tell if your property report is accurate. Clients recently were looking to purchase this property and they found it online. As we can see, it's a 4-bedroom, 2-bathroom, 2-garage property on 655 square meters in Moggill. And I guess looking at the overall view of the property, it's a probably mid-1980s or mid-1990s sort of a build, bit of wear and tear to it. But when we did an RP data report, so CoreLogic report, we provide these to our clients anytime they're interested in a property. We can see here that the estimated value spat out a $575,000 valuation with a range of anywhere from $530,000 to $622,000. The interesting thing here were the vendors were actually looking for offers over $600,000. So the clients asked us, what's the difference with this CoreLogic valuation and what the actual market's asking for?
And this is a common issue at the moment, especially in a rising market. The CoreLogic report and even sometimes the bank's own valuer are relying on sales that have taken place over 6 months ago.
So let's deep dive into this report in a little bit more details and see why this valuation or online estimate that's been provided by CoreLogic is a little bit lower than what we're expecting the market is actually asking for. As we can see in the recently sold section here, it's looking at properties that have sold in September last year and June last year and July. And with the market and the way it's been moving so quickly recently, unfortunately, these sales are a little bit too old and it's dragging down the report. So what we said with this customer here is how you can tell if your RP data CoreLogic report is accurate is by doing a few things. The first step is jumping on realestate.com and looking under the sold section, putting in the suburb that you're looking in. So we put in Moggill here, we put in a filter for 4-bedroom properties, and then looking at other properties that have recently sold. Now, the sooner the sale to today's date, the better. So anything that sold really 3 or 4 months ago is a bit too old. Having a look at this first property here at Outlook Place, once again, let's compare apples to apples. As I said, this property here looks like it's a mid-90s or 80s build, a little bit run down. So if we're comparing apples to apples, yes, it's a 4-bedroom property, it's on 2-bath, 2-garage, same sort of square meterage, but the overall spec is nowhere near the same. So using this $1,070,000 sale that happened in February as a comparable is probably not really just because these two properties are apples and oranges in comparison to each other. As we continue to scroll down, we continue to look at the property. This is a 5-bedroom property, not really comparable. Another property on a very large land set, so not that comparable. And we continue to scroll down to look at properties that might be similar. This one is a little close to it. Once again, a very high spec, so probably can't be used here. Once again, a larger square meterage. And we scroll down and we're getting close to properties that resemble the property we're interested in. Now, this is a larger property, sold for $690,000. It's on a much larger block of land, but similar sort of spec. That sold for $690,000. And then this one here in Joseph Avenue is very similar and sold for $775,000 in December. Now, as we're starting to look at sales in December, we're getting a little bit too old now in terms of the most recent comparable sales. But we can already say with these two sales that we've seen, we probably would expect this property to sell somewhere in the mid to high 6s.
So the CoreLogic report, while it helped give them a rough understanding of where the property is going to sell for, it really wasn't accurate. So they definitely knew if it was offers over 600, they definitely couldn't go under that. They ended up securing the place for 650,000. Like Nathan said, there are a couple of sales above that, which actually helped it. And I think because they were realistic and they didn't try and be too cheeky, they pretty much went in there with their first and final offer, they were able to secure the home.
So this is a great example of how you can fact check any online valuations you get by looking at the recent sales in the area and comparing it to get a good idea and gauge on what the market's willing to pay. Okay, well, moving on to the next one, we've seen a lot of fixed rate movements in the last 2 months. Previously, in late December, we're getting fixed rates from about 1.84% fixed in for 2 years. Fast forward all the way to the start of this year, and now we're in March and fixed rates have increased by more than 1%. A question we're getting asked a lot at the moment there, Jaden, is with fixed rates increasing, is this going to reduce my borrowing capacity?
In the short term, no, it's not going to make an impact to your borrowing capacity. The banks, when they work out your borrowing capacity, are working on a buffer or what they call a serviceability rate. So at a minimum, it's the current interest rates, usually the standard variable rate, plus 3%. So in a lot of cases, the bank's operating off a serviceability rate or an assessment rate of around 6%. It's obviously quite a lot higher than the current rates that are around, like Nathan said, 3% or thereabouts, variable rates, sometimes lower.
So Jaden, I guess the simplest way to look at this is if you're looking at a fixed rate, the bank's not actually assessing your application based on the fixed rate you're getting, on the rate the loan reverts to after the fixed period. So for example, if you've got a fixed rate of 2.99% for 2 years, after the second year, on the third year, when the fixed rate ends, it reverts to a variable rate of, let's say, 2.5%. Now, when the bank does their assessment, they're actually assessing your affordability based on that revert rate plus a 3% buffer. So in this situation, which is a variable rate, the fixed rate reverts to, plus 3%. So with fixed rates increasing, we actually haven't seen any changes in the variable rate, which means that your borrowing power isn't being affected. But if the variable rates do increase, do expect that your borrowing power might reduce because of these changes.
Another question on the same topic I get asked a little bit is what happens after the fixed rate period? So if, like Nathan's example, you're fixed for 2 years, what happens after that point? So like Nathan said, by default, you're gonna have 2 years of fixed followed by 28 years of variable. At the end of that 2-year period, you've got the choice. By default, it'll revert back to variable, but you can potentially extend it for a fixed rate at the time. So chat to your broker when that comes up and you can decide what's gonna work best for you at that time.
So one of Australia's biggest builders has gone broke, and what does it mean to you as a home buyer there, Jaden?
So this week, it was announced that ProBuild has gone into administration, which is obviously affecting hundreds of people, unemployed, and it's a pretty big situation because there's projects across Australia that are being affected. There's a couple of notable ones in Melbourne, I can see there, the Ribbon, $1 billion accommodation in Darling Harbour in Sydney, 25 Martin Place in Sydney as well, $170 million development, 443 Queen Street in Brisbane, a couple of tower projects in Uno in Melbourne and Westside Place. It's huge news because, like I said, it's affecting hundreds of staff and projects across Australia, and it's really unsure what's going to happen. There are only a few of these projects that were residential. The one in Queen Street in Brisbane was set to be completed at the end of 2022. The unfortunate thing, if you had happened to buy an apartment in this project, is that generally there'll be a sunset date for up to 5 years that the builder can complete the project. So it could mean that you're going to be waiting for a bit longer to get to your home because they have to change builders and go through that whole process. But I guess if you are looking at building, what happens in the situation where your builder goes broke?
So this is one we've seen happen recently, and it isn't a good situation to be in. When your builder goes broke, typically what happens is the build obviously stops and the progress payments to that point cease. So effectively the bank will stop paying the builder and you'll need to engage in a new builder to finish the project. The good thing with the banks and the way they do construction lending is that they pay the builder in arrears of the works being completed, and usually there's 5 different stages to build. You've got the slab down, the frame up, etc., etc. So if they've done the slab, they get paid. If they've put the frame up, they get paid, which means that typically if the builder does go broke, they might have partially completed some parts of the project in which the bank won't pay for because it hasn't been completed.
It can be a pretty tricky situation. It's definitely going to cause delays in your build, and it's not always easy finding another builder that's going to take over a half completed project. So I guess a few things you can try and do to try and protect yourself from this happening is 1, try and use a bigger brand name builder. I guess it didn't help in ProBuild situation, but you can potentially 2, find out who they're owned by. ProBuild was owned by a South African company. They tried to sell it to a Chinese conglomerate last year and actually got blocked by the federal government. So potentially during that, they've had some cash flow issues and that's caused issues. But I guess with your builder, ask them how they owned, who they owned by, how many projects they got running, how many people they got working for them. Or three, even talk to some of the tradespeople on site. You know, if you start hearing them grumble about their pay being late or issues with the building, it's definitely some red flags there.
I think a big thing we've seen recently as well with builders going broke is that there's genuinely been issues with increased costs, supply shortages, cost of materials going up exponentially. So this is one thing that you also might want to chat with your builder and talk about what happens if costs increase. Will that be passed on to me as a variation? Because your contract for your builder is always fixed price. So how are they going to manage all that? So this is where it makes sense to have a good quality conversation with your builder before you start anything. And moving on to our bonus section, which is the most viewed properties through Domain this week. So having a look from the top at Domain's most viewed properties, we see this beautiful property in Lennox Heads on the Blue Seas, and it's absolutely magnificent. Very high spec build, looks amazing, beautiful views, and that thing is a beauty. So moving on from Lennox Heads to this beauty in Melbourne, right in the middle of Richmond, an absolute stunner. A lot of potential, completely run down, but you know what? It could be the worst property on the best street. So it's interesting to see, and it'd actually be interested to see what it actually sells for. So there's much more properties with Queensland and the Australian Capital Territory, South Australia, Tasmania. We'll actually include a link down the bottom so you can check it out yourself later. And that's pretty much it, guys. So if you're needing assistance with finance and you're living in Australia, here at Hunter Galloway, we can help. We're the mortgage broker that finds the right solution for you. So hit us up at huntergalloway.com.au or call us on 1300 088 065 and we'll see you next time.